In the ever-evolving landscape of personal finance and investment, one of the endless questions that individuals face is how to make their money work for them efficiently and safely. Two prominent options that frequently come under consideration are bonds and bank deposits. Both have their advantages and disadvantages, and understanding these distinctions is pivotal for anyone seeking to optimize their financial strategy. In this video, we will delve into the depths of bonds and bank deposits, unraveling their complexity, and examining their suitability for various financial goals. Whether you're a seasoned investor or someone just embarking on their financial journey, this discussion will offer invaluable insights into making the right choice to safeguard and grow your wealth. The essence of bonds. Bonds are, at their core, debt instruments. When you invest in a bond, you are essentially lending your money to an entity, be it a corporation or government, in exchange for periodic interest payments and the return of your principal amount at the end of a predetermined period, known as the maturity date. The advantages of bonds. Predictable returns. Bonds typically provide a fixed interest rate, making them a stable source of income. This predictability can be particularly appealing to risk-averse investors or those seeking a steady stream of income in retirement. Diverse options. Bonds come in various forms, including government bonds, municipal bonds, corporate bonds, and more. This diversity allows investors to tailor their bond investments to their risk tolerance and financial goals. Relative safety. Bonds are generally considered safer investments compared to stocks because they are less volatile. Government bonds, in particular, are often seen as nearly risk-free due to the backing of the government's ability to tax and print money. Portfolio diversification. Bonds can play a crucial role in diversifying an investment portfolio. When stocks are performing poorly, bonds may provide a buffer against losses. Tax benefits. In some cases, interest income from certain types of bonds, such as municipal bonds, may be tax-free, offering additional advantages for investors in higher tax brackets. The limitations of bonds. Lower potential returns. While bonds are generally safer, they also offer lower potential returns compared to riskier investments like stocks. The trade-off for stability is a potentially slower wealth accumulation. Inflation risk. Fixed-rate bonds may be susceptible to losing purchasing power over time if inflation rates outpace the interest earned. Interest rate risk. Bond prices are inversely related to interest rates. When interest rates rise, the market value of existing bonds may fall. This can result in capital losses for bondholders who wish to sell before maturity. The effectiveness of bank deposits. Bank deposits, on the other hand, are straightforward savings or checking accounts held in banks. They include savings accounts, certificates of deposit, CDs, and money market accounts. The advantages of bank deposits. Safety and liquidity. Bank deposits are among the safest places to park your money. They are insured by the government up to a certain limit, providing peace of mind. Additionally, these accounts offer easy access to your funds, ensuring liquidity when needed. Simplicity. Opening a bank deposit account is typically hassle-free, making it an ideal choice for those who prefer a straightforward and uncomplicated approach to managing their money. Steady returns. While not as high as the potential returns from riskier investments, bank deposits offer a consistent, albeit modest, interest rate. This can be an attractive option for individuals who prioritize safety over high returns. No market risk. Unlike bonds, the value of your bank deposits does not fluctuate with interest rates or market conditions. Your principal amount remains stable. No investment knowledge required. Bank deposits are a perfect starting point for novice investors or individuals who do not wish to delve into the complexities of financial markets. The limitations of bank deposits. Limited returns. The interest rates on bank deposits are generally lower than what can be achieved with other investment options. This can lead to slower wealth accumulation, especially when accounting for inflation. Inflation erosion. Just like bonds, bank deposits can be vulnerable to the erosive effects of inflation. If the interest rate on your deposit account does not outpace inflation, your purchasing power will diminish over time. Opportunity cost. By opting for bank deposits, you may miss out on potentially higher returns available in other investment avenues, like stocks or real estate. Interest income taxation. Interest income earned from bank deposits is typically subject to income tax. This can reduce the overall return on your investment, particularly if you are in a higher tax bracket. The path to financial prosperity. So, which option is the right one for you, bonds or bank deposits? The answer lies in your financial goals, risk tolerance, and investment horizon. 1. If safety and liquidity are paramount. If your primary concern is safety and liquidity, bank deposits are the natural choice. They offer a high degree of protection for your capital and easy access to your funds. 2. If steady income is the priority. For those who rely on a steady income stream, bonds, especially government or corporate bonds, can provide regular interest payments, making them suitable for retirees or individuals seeking income stability. 3. If you seek capital preservation with moderate returns. If you want to protect your capital from market volatility but still aim for better returns than traditional bank deposits, consider a mix of bonds in your portfolio. Bonds can provide a balance between safety and moderate growth. 4. Long investment horizon. If you have a long investment horizon, such as for retirement planning, and are willing to tolerate some level of risk, a diversified portfolio that includes stocks, bonds, and other assets may be more appropriate. This approach can potentially yield higher returns over time. 5. If you value simplicity. Bank deposits are unbeatable when it comes to simplicity and ease of management. If you prefer a hands-off approach to your finances, they are a convenient choice. 6. If you are tax-averse. Consider tax implications when making your choice. Some bonds may offer tax advantages that can make them more attractive from a tax efficiency perspective. In the realm of personal finance and investment, the decision between bonds and bank deposits is not one size fits all. Each option has its strengths and weaknesses, and the right choice depends on your individual circumstances, financial objectives, and risk tolerance. While bank deposits offer safety and simplicity, bonds provide a blend of safety and moderate returns. As you chart your financial journey, remember that diversification can be a powerful strategy. A well-balanced portfolio that includes a mix of asset classes, including bonds and bank deposits, can help you achieve your financial goals while managing risk. Ultimately, the path to financial prosperity is unique to each individual. It may involve a combination of both bonds and bank deposits or a more complex investment strategy. The key is to align your choices with your long-term objectives and to stay informed about the ever-changing landscape of finance and investment. By doing so, you can navigate the waters of wealth building with confidence and clarity, moving steadily toward your financial aspirations.